Tom Lee just called the recent market sell-off a gift. In today's video we're breaking down exactly why he thinks the setup into year-end is still bullish, what's happening under the hood with earnings, rates and AI, plus the surprising link between gold and crypto that you probably didn't see coming. Tom Lee, head of research at Fundstrat and CIO of Fundstrat Capital, joined CNBC's Squawk Box to lay out the case for staying optimistic, and I'm going to translate his key points into plain English and show you how I'm thinking about positioning. Here's the plan. First, we'll watch Tom's clip. Then I'll give you my rapid-fire reaction, why a volatility spike can actually be a constructive signal, why CEO caution turning into confidence matters for stocks, and why valuations on the market's leaders aren't as unhinged as the bubble talk suggests. After that, I'll walk you through my picks for the 3 best growth stocks to buy now. If you want the no-noise version of what's really moving this market, and a clear framework you can use on red days and green days, stick with me. Smash the like button, share this with a friend who panicked on the dip, and drop your questions below. Make sure you're subscribed so you don't miss the deep dive on those 3 stocks coming up right after Tom's remarks. Alright, let's roll the clip of Tom Lee, and then I'll break it down.
Markets bouncing back after Friday's drop. Joining us now, Tom Lee, head of research at Fundstrat Global Advisors and Fundstrat Capital CIO. Tom, just summarizing what your thoughts are this morning. I don't see a whole lot that has shaken your confidence that the market's headed up. You still see 7,000 on the S&P by year end. You do point out it's not cheap, up 36% since the April lows. You do outline some headwinds, but I think you're outlining more positives than negatives for the markets, even right now.
Yeah, in fact, I think JP Morgan's announcement today really ties into why investors should stay pretty constructive on the U.S. I mean, JP Morgan, the biggest and the most powerful bank in the world, is investing $1.5 trillion into the U.S., into things that are going to strengthen sort of U.S. advantages, critically important areas. And at a time when the U.S. is dominating AI, and of course now we have this big tailwind as blockchain is an initiative that Wall Street is building products on. So I think there's a lot of reasons for investors to stay optimistic. And I know there's a lot of talk about bubbles, but I think the thing I would just continue to point out is NVIDIA trades at around 27 times forward earnings. It's still on a PE basis cheaper than Walmart and Costco, which trade at around 47 and 34 times forward earnings.
Yeah, you've got positive reasons to think that earnings are going to do well in a time when interest rates are coming down. So that's just like an elixir for stocks that is very powerful.
That's right. And as you know, CEOs have not been that confident for the last 2.5 years because the Fed's been running tight monetary policy. The ISM's been below 50 for 31 months now. That's the longest stretch in history. I think the sell-off Friday is giving us a bit of a gift because that surge in the VIX, a 32% rise, is the 39th highest ever one-day surge. And the 1-month median return is almost 3%. Of the 38 other instances. So I think the S&P could add, 200 points between today and mid-November.
Still got, we're not overly positive in terms of sentiment right now, so that's not late cycle according to you at this point. And still a hated rally, $7 trillion on the sidelines if people decide they want to go into stocks.
Yeah. I think conviction is a measure of whether or not the market is, pricing in too much good news. I think with Friday's sell-off, I saw many people calling the top of the markets or declaring that the bubble is bursting or that, this is the reason to be buying gold. And if investors are that quick to call a top just on a 2.7% decline, I just think a lot of good news isn't really priced in. I think there's still a lot of reluctant investors on the sidelines.
You have found a kind of everything's about crypto. You found a reason gold's up, and it's because of crypto. Not directly because of crypto, but you think the incremental buyer in gold there's gold-based stable coins, and people need to buy gold to back the stable coins. And that you think that's enough to be up $92 all the way up to a new high?
Well, there is an interesting correlation we found, which is when I look at Tether's supply of dollars outstanding it really started to rise about 3 months ago, and that corresponded with gold essentially going up every day. I'm not positive of this, but I think stablecoins, including Tether, may be one of the largest buyers of gold today.
That's perfect. So the people that have been bullish on gold for so long and bearish on crypto and Bitcoin, they're finally getting their big rally in gold, and it's because of the thing they hate so much, crypto and Bitcoin.
Yeah, that's right.
That's so funny.
Tether is proving to be a good meeting ground between Bitcoiners and gold people.
Tom, can you just explain, though, to the extent we can understand it, within at least the Bitcoin world, just how much leverage there is in that system? Because I think one of the things that we were looking at Friday was the possibility, at least, that some of that selling, or maybe even a lot of that selling, came from margin calls at that time.
Andrew, there's always been a lot of leverage in crypto. I think that the volatility and leverage is what has drawn people into that space, especially when you get outside of Bitcoin and Ethereum. Those two are generally not held on margin. I mean, there is some leverage with what they call perpetuals, but that's why they held up so well over the weekend. But this liquidation that was triggered over the last 3 days, the estimates are at least 19 billion of liquidations, but it's probably understated. It might be 4 times bigger. It's the largest since 2021. Essentially, you have to go back to FTX. I think there is a lot of leverage in the way people use this product called perpetuals, which is trading on margin, like 3x, 20x. And it lurks and it's held through collateral. People like sort of pledging something that thinks it's safe, but when the price of that collateral drops, it triggers a cascade. Right. And so I think people talk about this thing called auto deleveraging. So a lot of leverage, yes.
First, the headline view. Tom's base case is still bullish. He hasn't wavered on a high year-end target for the S&P 500, and he thinks last Friday's pullback didn't break the uptrend. It may actually have refreshed it. The key idea is that the fundamental backdrop he's watching, earnings power, easing rates, and powerful secular tailwinds in AI and now blockchain, remains intact. If you strip away the noise, he's basically saying the forces that pushed markets higher are still in place, and the latest drop looks more like a sentiment shock than a change in the underlying story. Let me break down his pillars one by one. Tom starts with a marquee signal of corporate commitment to the U.S. economy. He points to J.P. Morgan, which he calls the world's most powerful bank, investing $1.5 trillion into the U.S., in areas that reinforce structural advantages. Whether you agree with the exact magnitude or not, the message is the key. The biggest, most system-critical institutions are still deploying massive capital domestically. When the largest bank is leaning into U.S. infrastructure, innovation, and financial plumbing, it's hard to claim we're at the end of the cycle. That kind of investment tends to spur productivity, credit creation, and corporate activity, things that don't usually align with imminent recessions. Next, he layers in the AI and blockchain tailwinds. On AI, Tom's point is straightforward. The U.S. is dominating the stack, from chips to models to enterprise adoption, which keeps a powerful growth engine running underneath the index. On blockchain, he frames it not as a speculative craze, but as an institutional initiative, Wall Street building real products. The takeaway is secular. Even if you dislike crypto, you can't ignore that financial infrastructure is evolving, and some of that value accrues to listed companies and the broader ecosystem. Now, valuation. This is where critics love to pounce. It's a bubble. It's too expensive. Tom counters with a specific comparison. Nvidia's forward PIE around the high 20s versus non-tech retail giants like Walmart and Costco, which he cites in the mid-30s to mid-40s. The point isn't that Nvidia is cheap in a vacuum. It's that the market's most powerful earnings engine isn't being priced like science fiction relative to stalwarts with far slower growth. You may or may not buy that framing, but it's a useful gut check. Valuation has to be viewed alongside growth, margins, and durability. If earnings expand faster than price, even expensive can compress quickly. Then he hits the macro elixir. Earnings trend up while interest rates trend down. That mix is historically potent for equities because lower discount rates boost the present value of future cash flows. At the same time, profits are improving. He also notes CEOs have been unusually cautious for 2+ years. tight Fed policy, and an ISM manufacturing index below 50 for a record-long stretch. Why does that matter? Because when management confidence has been depressed for that long, even small improvements can unlock hiring, capex, and guidance upgrades. Markets discount change at the margin, not the absolute level. What about the sell-off that kicked all this off? Tom calls it a gift. He highlights the VIX volatility index spiking 32% in a single day, among the biggest one-day jumps historically. When fear surges that violently, the forward one-month median returns have often been positive. He even quantifies it using prior episodes, roughly a 3% median gain over the next month in similar cases, and he thinks the S&P could tack on 200 points into mid-November. You don't have to memorize the stats. The underlying logic is that panic hedging tends to overshoot, and when that air clears, buyers find better entries. Sentiment is the next piece. He frames this as a hated rally, with an estimated trillions parked on the sidelines. The behavior he's watching, how fast investors declare a top. If a 2-3% down day triggers instant "the bubble just burst" narratives and a stampede into gold, that says conviction in stocks is still fragile. Low conviction means less exuberance is priced in, and more dry powder can flip back when the tape stabilizes. That asymmetry supports his view that we're not late cycle euphoria, we're still climbing a wall of worry. Now, a quirky but interesting angle. Gold surge. Tom ties the move not to classic macro fears, but to the plumbing of crypto. Specifically, he points to the supply of dollar-denominated stablecoins, like Tether, ramping in recent months, and he suggests that gold-backed stablecoin activity could be a significant incremental buyer of physical gold. If that's right, there's a delicious irony. Longtime gold bulls who dislike crypto might be getting their rally thanks to crypto's growth and the need to source gold collateral. The broader lesson is that modern market flows are increasingly intertwined. Liquidity in one corner can ripple into seemingly unrelated assets. Of course, none of this ignores risk, and Tom addresses the elephant in the room: leverage in crypto. He distinguishes between Bitcoin, Ethereum, which he says are generally less margin-heavy, and the broader long tail where perpetual futures can run at 3x to 20x leverage. When collateral prices fall, you get forced liquidations, a cascade effect. He cites estimates of roughly $19 billion in liquidations over the last 3 days, and suggests the true number could be several times that, comparable to the biggest waves since 2021. Why should equity investors care? Because abrupt crypto deleveraging can spill into broader risk sentiment, tightening financial conditions at the margin and amplifying volatility across assets. It's not the same as 2008. Crypto isn't embedded in the banking system the way mortgages were. But it can still punch markets in the face for a few sessions. Let me add my take on how to operationalize all this. First, on the trend versus the tremors. Tom's framework asks you to separate sentiment shocks from structural drivers. If earnings revisions stay positive and rates continue easing, pullbacks are more likely to be interruptions than reversals. In practice, that argues for having a plan to add on fear spikes, rather than chasing rips or capitulating on down days. You don't need to be heroic. Ladder into strength names on your watch list with staged entries. Second, on valuation, use relative context, not just absolute multiples. If you're evaluating high-growth leaders, anchor on forward earnings power, margin durability, and competitive moats. If those hold, small changes in cost of capital can have outsized effects on fair value. Be honest about how much of the safety premium you're paying. Third, on the hated rally dynamic. This is a psychological market. Indicators of low conviction, quick top call-in, heavy hedging, and persistent cash on the sidelines tend to correlate with upside surprises when the data doesn't break. You can lean into that by predefining your ads during volatility spikes instead of trying to be a hero in real time. Volatility plans beat volatility emotions. Fourth, on gold and crypto plumbing. Even if you don't trade either, remember that cross-asset liquidity matters. Stablecoin growth, collateral mechanics, and forced liquidations can create short, sharp air pockets in risk assets. If you see those cascades, widen your time horizon. 3 to 6 weeks later, the macro drivers often reassert themselves. Use those windows to improve your cost basis rather than abandoning the thesis. Fifth, on macro tells, watch CEO tone and the ISM trend. If we move from contraction to expansion, that inflection often precedes upgrades in guidance and capex. Pair that with a down-shifting rate environment, and you have the elixir Tom is talking about: higher E, lower R. Markets care about the direction of change, not the level of noise. Now, risks Tom's framework doesn't eliminate. If rates were to re-accelerate higher or earnings were to roll over meaningfully, the bull case would need to be rescored. Also, crypto deleveraging doesn't have to respect tidy timelines. If liquidations keep snowballing, it can pressure broader sentiment longer than you think. And finally, secular winners are not immune to position size risk. Leaders can correct 20-30% inside an ongoing uptrend, so manage exposure accordingly. Bottom line, here's how I'm interpreting Tom Lee's interview. We just lived through a sentiment shock, not a thesis break. The big drivers, U.S. capital investment, AI adoption, and a friendlier rate backdrop, are still in place. Valuations at the top aren't as unhinged as the bubble narrative suggests, especially when you compare growth to staples. The VIX spike historically leans bullish over the next month, and the quick rush to call a top tells me the wall of worry is alive and well. Meanwhile, gold's rally may be a byproduct of crypto's expanding financial rails, and the leverage purge in the long tail of tokens explains the weekend turbulence without rewriting the equity story. So, for investors, keep your shopping list ready, stagger entries on weakness, size positions to survive volatility, and let earnings plus easing rates do the heavy lifting. That's the practical takeaway from Tom's playbook, and it's how I'm thinking about the path into year-end. If this breakdown helped you connect the dots, tap the like button, share it with a friend who panicked on the last red day, and drop your questions below. I'll keep tracking these macro signals for you and translate them into actionable context for your portfolio. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now, let's dive into the 3 best growth stocks to buy now. First up, let's talk about Urban Outfitters, ticker symbol URBN. While many investors focus on the big names in retail, Urban Outfitters is quietly rewriting the playbook for success in a sector that's been under immense pressure. In a world where traditional retailers are struggling to keep up with changing consumer habits, URBN stands out as a disruptor that's not getting the attention it deserves. In a tough retail sector, they're not just surviving, they're thriving by being different. Walk into any Urban Outfitters store and you'll notice the energy. It's not just about selling clothes, it's about creating a vibe, a sense of belonging, and a destination that feels more like a cultural hub than a traditional store. What really sets URBN apart is their brand ecosystem. They've built a portfolio that includes Urban Outfitters, Anthropologie, and Free People, each one with its own distinct identity and fiercely loyal customer base. This isn't just a collection of stores, it's a network of brands that complement each other and reach different segments of the market. This diversification is a strategic masterstroke. If one brand faces headwinds, the others can pick up the slack, smoothing out the company's overall performance. It's a built-in safety net that many single-brand retailers simply don't have, and it allows URBN to weather industry cycles with more stability. But URBN's secret sauce goes beyond just having multiple brands. They focus on building a sense of community and experience in their stores. Whether it's hosting live music, art installations, or pop-up events, they turn shopping into an event, something memorable that keeps customers coming back. Their seamless integration of e-commerce and physical stores is another key advantage. Customers can browse online, pick up in-store, or have items delivered to their door. This omni-channel approach not only enhances engagement but also meets customers wherever they are, making shopping with URBN effortless and enjoyable. Financial discipline is at the core of their operations. URBN manages inventory with precision, avoiding the deep discounts that erode margins for so many competitors. By keeping a close eye on trends and demand, they're able to maintain strong profitability even when the market gets tough. Growth isn't just coming from clothing. Anthropologie's home goods line has become a standout performer, tapping into the booming market for stylish, curated home decor. And then there's Nuuly, URBN's innovative subscription service that's changing the way people think about fashion consumption. Nuuly is a game changer. It taps directly into the sustainability movement, offering customers a rotating wardrobe for a monthly fee. This not only appeals to eco-conscious shoppers, but also gives people a way to experiment with new styles without the commitment of buying. The subscription model creates a steady, recurring revenue stream, something every investor loves to see. It increases customer lifetime value and builds a deeper relationship between the brand and its users, making them more likely to stick around for the long haul. Despite all these strengths, URBN's valuation still doesn't fully reflect its growth potential. especially with newly just getting started. Compared to peers, the stock trades at a discount, which could mean there's significant upside if the market catches on. The company's strong balance sheet is another major asset. With plenty of cash and manageable debt, URBN can invest in new initiatives, expand internationally, and weather economic downturns without having to make drastic cuts or take on risky loans. URBN's brands have a unique resonance with younger consumers, especially Gen Z and millennials. These shoppers are looking for authenticity, self-expression, and brands that align with their values, and URBN delivers on all fronts, from unique product curation to inclusive marketing. International expansion is a huge opportunity on the horizon. With a proven formula in the US, URBN is now setting its sights on Europe and Asia, where demand for Western fashion and lifestyle brands is growing rapidly. This could unlock a whole new wave of growth in the years ahead. Of course, fashion is a notoriously risky business. Trends can change overnight, and what's hot today might be out tomorrow. But URBN's multi-brand strategy helps mitigate these risks, allowing them to pivot quickly and stay ahead of the curve. They're also leveraging data analytics to guide their design and inventory decisions. By analyzing customer preferences and sales trends in real time, URBN can react faster than competitors, reducing the risk of costly fashion misses and markdowns. This data-driven approach extends to marketing as well, allowing URBN to tailor campaigns to specific audiences and maximize return on investment. They're not just guessing what customers want, they're using real insights to deliver it. Even in the face of economic uncertainty, URBN's affluent customer base provides a cushion. These shoppers are less likely to pull back on spending during downturns, making the company's revenue streams more resilient than many of its peers. Behind the scenes, URBN is a well-run business with a seasoned management team. They've shown an ability to adapt to changing market conditions, invest in innovation, and execute on long-term strategies that set them apart from the competition. Yet despite all these strengths, the market continues to overlook URBN's long-term potential. This disconnect between perception and reality creates a compelling opportunity for investors who are willing to look beyond the headlines. Urban Outfitters comes in with a market cap around $6.2 billion. The company earned $5.10 per share, which puts it at a price-to-earnings ratio of about 13.6, reasonable for a specialty retailer. Revenue for 2024 was roughly $5.1 billion, translating to net income of $287 million. So you're seeing profits that back up the multiple rather than just top-line growth. As URBN continues to execute its strategy, expanding its brands, growing newly, and reaching new markets, I expect the market to reevaluate the stock and assign it a higher multiple, reflecting its true potential. In the end, Urban Outfitters is more than just a retailer. It's a story of resilience, innovation, and brand power. A company that's redefining what it means to succeed in modern retail. If you're looking for a disruptor that's flying under the radar, URBN deserves a closer look. Next, let's turn our attention to Micron Technology, ticker symbol MU, a company that stands as a cornerstone in the global semiconductor industry. While it may not be a household name like some of its peers, Micron's impact on the digital world is profound and far-reaching. Every day, billions of people rely on devices powered by Micron's innovations, often without even realizing it. Micron specializes in producing essential memory and storage solutions, think DRAM, NAND, and SSDs, that are the backbone of modern technology. These components are critical for everything from smartphones and laptops to data centers and autonomous vehicles. The demand for memory is exploding at an unprecedented rate, fueled by the rise of artificial intelligence, the rollout of 5G networks, the proliferation of Internet of Things devices, and the ever-expanding world of cloud computing. As our digital lives become more complex, the need for faster, more reliable memory only grows. In this highly competitive landscape, Micron, along with Samsung and SK Hynix, forms an oligopoly that dominates the global memory market. These three companies control the vast majority of supply, setting the pace for innovation and pricing across the industry. Historically, the memory industry was notorious for its boom and bust cycles, with wild swings in pricing and profitability. However, in recent years, the sector has matured, shifting toward more stable and disciplined growth. This transformation is driven by smarter supply management, longer product cycles, and a broader range of end markets. Today, demand for memory is more diversified than ever before. Data centers, smartphones, and the automotive sector all require vast amounts of memory and storage, which helps reduce the industry's historical cyclicality. For example, autonomous vehicles and electric cars are packed with sensors and processors, all of which depend on high-performance memory. Artificial intelligence, in particular, is a massive tailwind for Micron. AI workloads require enormous amounts of high-bandwidth memory to process data quickly and efficiently, As AI adoption accelerates across industries, the demand for advanced memory solutions is set to soar. Micron is at the forefront of developing next-generation technology for AI and machine learning. The company invests heavily in research and development, pushing the boundaries of what's possible in memory performance, power efficiency, and reliability. Their innovations are helping to unlock new capabilities in everything from cloud computing to edge devices. The explosion of data creation, driven by social media, streaming, and enterprise applications, has led to surging demand for NAND flash memory. As more information is generated and stored every second, the need for fast, reliable storage solutions becomes even more critical. Micron is a leader in NAND technology, driving the adoption of solid-state drives in data centers and enterprise environments. Their SSDs offer the speed, durability, and efficiency required to keep up with the world's insatiable appetite for data. Financially, Micron is on solid ground. The company maintains a strong balance sheet and continues to invest aggressively in both R&D and advanced manufacturing. This commitment ensures that Micron remains competitive and well-positioned for future growth. Of course, Micron's stock can be volatile, reflecting the cyclical nature of the semiconductor industry. But for long-term investors, these fluctuations can create attractive buying opportunities, especially when the market underestimates the company's long-term potential. Valuation is often mispriced due to the industry's cyclical history. Savvy investors focus on mid-cycle earnings and the company's ability to generate sustainable profits across different market environments, rather than getting caught up in short-term swings. Micron Technology carries a market cap near $216 billion. Earnings per share landed at $7.59, and at today's price, that's a PE of about 25.4, which investors are willing to pay given the memory cycle upturn and AI-driven demand. For 2024, Micron booked $25.11 billion in revenue and $778 million in net income. Modest profitability now, with the expectation of stronger operating leverage as pricing and bit shipments continue to improve. However, risks remain. The industry is still subject to cycles, and geopolitical tensions, such as trade disputes and supply chain disruptions, can impact operations and profitability. The global nature of the semiconductor supply chain means that events in one region can ripple across the entire industry. To address these challenges, Micron is actively diversifying its manufacturing footprint. By expanding production in multiple countries and regions, the company aims to reduce its exposure to geopolitical risks and ensure a more resilient supply chain. Ultimately, Micron's products are indispensable to the global technology ecosystem. From powering the latest smartphones to enabling breakthroughs in AI and cloud computing, Micron is a key beneficiary of powerful, long-term growth trends that are reshaping our world. Despite this, the market often underestimates Micron's ability to deliver sustained profitability and growth. As technology continues to advance, Micron's role will only become more critical and its growth potential more apparent. In summary, Micron Technology represents a compelling opportunity for those looking to invest in the digital future. As the unseen engine powering our connected world, Micron is poised to benefit from the next wave of technological innovation. Finally, let's talk about Western Digital Corporation, ticker symbol WDC, a true titan in the world of data storage. With a legacy that stretches back decades, Western Digital has become synonymous with reliable, high-capacity storage solutions that power everything from personal computers to the world's largest cloud data centers. Their influence is so pervasive that whether you realize it or not, your digital life is likely touched by Western Digital technology every single day. Western Digital is the undisputed leader in the hard disk drive, or HDD, market, especially when it comes to mass-capacity storage for data centers. These are the backbone of the internet, storing petabytes of information for cloud giants, social media platforms, and enterprise clients worldwide. HDDs remain the go-to solution for storing massive amounts of data at the lowest possible cost per gigabyte. This is absolutely essential for cloud service providers, who need to balance performance, reliability, and cost as they scale up to meet the world's insatiable demand for data. Western Digital isn't just resting on its laurels, they're pushing the boundaries of what's possible in storage technology. Innovations like energy-assisted magnetic recording, EAMR, and shingled magnetic recording, SMR, allow them to pack more data onto each drive, increasing capacity and efficiency for their customers. But Western Digital is more than just spinning disks. Their flash memory segment, which includes the well-known SanDisk brand, is a fierce competitor to industry heavyweights like Micron. They offer a full suite of solid-state drives, SSDs, and memory cards, serving everything from smartphones and cameras to high-performance enterprise servers. By combining their HDD and flash memory businesses, Western Digital provides a truly comprehensive storage solution. This unique position allows them to serve customers across the entire spectrum of storage needs, from archival cold storage to lightning-fast SSDs for artificial intelligence and analytics. Recognizing the distinct dynamics of these two markets, Western Digital is now in the process of separating its HDD and flash businesses into two independent companies. This strategic move is designed to unlock the full potential of each segment, allowing them to focus on their unique strengths and growth opportunities. For investors, this split is a major catalyst. By creating two focused companies, Western Digital aims to unlock significant shareholder value, as each business can be more accurately valued and managed according to its own market realities. The new standalone flash company will be laser-focused on high-growth markets like mobile devices, data center SSDs, and edge computing. With the explosion of data from AI, 5G, and the Internet of Things, demand for fast, reliable flash storage is only going to accelerate. Meanwhile, the HDD company will appeal to value and dividend-focused investors. With a mature, consolidated market and steady demand from hyperscale data centers, this business is positioned to generate strong cash flows and return capital to shareholders. The separation is widely expected to enhance market valuation for both entities, as investors can more clearly see the strengths and prospects of each business on its own. Adding to their competitive edge, Western Digital's long-standing joint venture with Kioxia, a leading Japanese memory manufacturer, gives them a powerful position in the global NAND flash market. This partnership enables them to share technology, reduce costs, and accelerate innovation. The flash business is set to benefit from the rapid adoption of SSDs in data centers and the surging storage needs of artificial intelligence applications. As AI workloads grow, so does the need for high-speed, high-capacity flash storage. On the HDD side, growth is driven not by selling more units, but by increasing the capacity of each drive. As data centers demand ever larger drives to store vast amounts of information, Western Digital is at the forefront of this technological race. The market for high-capacity enterprise drives is highly consolidated, with just a handful of players. This ensures healthy profit margins and reduces the risk of price wars, making it a stable and attractive business. Of course, Western Digital has faced its share of challenges. Recent financial headwinds have largely been the result of a cyclical downturn in the flash memory market, which is notorious for its boom and bust cycles. But there's good news on the horizon. The flash market is showing clear signs of recovery, with prices stabilizing and demand picking up. This turnaround is expected to drive improved financial performance in the coming quarters. Still, investors should be aware of the risks. The NAND market remains cyclical and unpredictable, and the execution of the business separation will require careful management to avoid disruptions. Western Digital sits at roughly a $40.6 billion market cap. EPS is $4.46, which equates to a PE of about 26.6, reflecting a market that's looking ahead to margin recovery and the spin realignment narrative in high-performance storage. Revenue for 2024 came in at $6.31 billion. Taken together, you've got a retailer trading at a value-tilted multiple with solid profitability, a memory leader priced for a cyclical and AI tailwind, and a storage player with improving earnings power as the cycle turns. Fortunately, Western Digital's management team is highly incentivized to make this transition a success. Their experience and strategic vision are key assets as the company navigates this pivotal moment. In a world where data is the new oil, Western Digital stands as an essential pillar of the digital economy. With a clear catalyst for growth, a history of innovation, and a bold strategy for the future, this is one data storage giant you simply can't afford to ignore. Urban Outfitters, Micron Technology, and Western Digital are three growth stocks with strong market positions and potential. They offer a mix of innovation, resilience, and strategic catalysts. Investing is a marathon. These companies are solid picks for long-term growth. For exclusive tips and analysis, join the Stocks Galore Patreon community. Which stock do you think has the most potential? Share your thoughts in the comments. Like, subscribe, and stay tuned for more investing insights. Thanks for watching.